Hello, everyone. I'm honored to be here today to report on the survey results of the commercial real estate industry for the year 2024. Thank you to those of you who filled out the survey that was given last month in October. It's the 22nd time that we've done this survey, and usually I try to take a 10-year snapshot in order to provide you that scope of information. The commercial real estate landscape continues to evolve, but I think I can safely say that this year's numbers were filled with much more optimism than in the last several years. A few things that were market themes impacting that sentiment include the following. One, many have said they have already seen the bottom. Coming out of COVID closures and high inflation, we are starting to normalize globally and at home. Second, new construction has slowed due to that inflation, labor supply chain, and more. However, it's improving. Three, flight to quality across multiple sectors. We heard about this in office for a long time, and now it's really starting to be a pull-through theme for retail as well. And fourth, insurance costs remaining a huge concern. We saw that in some of the comments. They're difficult to budget for and have been increasing. In 2023, like I need to tell you this, more than 20%, and in Q1 2024, over 10%, driven by natural disaster concerns and, of course, inflation. So let's get on with the survey results. First, we asked members about the condition of the current real estate market. Most respondents suggested it is improving from 2023. Recall what was happening, though, in 2021 as we were coming out of the pandemic and had nowhere to go but up. While those saying the market is flat hovers at 50%, only 10% now say it is weak. Midwest real estate continues to be a stable investment. You can see the year over year, and I can share these slides with you as well. When we ask the next question about the southeastern Wisconsin commercial real estate market for 2025, we see that this is a very optimistic group. Inflation easing and interest rates coming down. In fact, today we just got an announcement that it came down 25 basis points, with 92% saying that 2025 is going to be a very good year. Next question, how do you describe the current condition of the capital markets for commercial real estate? For the past 2 years, the overall sense has been that cap rates are flat or declining, but the survey suggests that we are seeing those rates improving. More than 90% of respondents said as much. Now we look at the individual markets. We asked members, how would you describe the outlook for the Southeast Wisconsin office market? Office has been arguably the most disruptive of the commercial real estate sectors. More than half, or 53% of respondents, said that the office market was declining in 2023. But in 2024, 70% said it was flat or improving. I'll take that as a win. Additionally, large users and heavy office markets are mandating in-office policies. Just last week, we saw Amazon, Starbucks, and JP Morgan, to name a few. Talk to an office broker, and they're busy. Fewer large transactions are taking place, but many smaller ones drive the numbers, which in Q3 2024, according to our Moody's report, we saw more than 308,000 square feet in lease activity over 92 transactions in Southeast Wisconsin. Conversions and adaptive reuse scenarios are also driving discussions and decisions. Next, we looked at the industrial market. CARW members have long been bullish on the industrial market, with nearly half saying the market is improving. Cost of construction, supply chain, interest rates, and zoning continue to challenge growth. However, demand remains strong with economic conditions improving. Retail. Many members suggest that 2024 will continue to improve. The sector has seen rent growth in some areas because of well-positioned real estate and lack of new supply. Incentives by landlords is limited. Pretty positive, right? The sentiment relayed in the data is only one piece of the equation. Our market is impressive, intuitive, and the connectivity really leads to this innovation. So bravo to all of you for another great year. BizTimes had a few other questions that we'll roll through here. Which of the real estate sectors in Metro Milwaukee are most in danger of being overdeveloped? We did a comparison of the last 6 years. This year, respondents suggest, once again, that apartments appear to be the most likely to be overbuilt. I think some multifamily developers may disagree, but southeastern Wisconsin continues to add hundreds of multifamily housing units, and nationally, of course, it is considered the most investment-safe product type out there. We see office as the next most likely to be overbuilt, but according to the Q3 2024 Moody's report, there's 20,300 square feet currently under construction in 2 projects. 5 office properties were delivered with almost 200,000 square feet to date. Next question. Should the Wisconsin DOT convert I-794 between downtown Milwaukee and the 3rd Ward from an elevated freeway into a surface street boulevard to help attract development? We've been tracking this controversial question for 3 years now, and you can see that with education and information, people are settling around making minor modifications to continue connectedness of 794 that it provides to the lakefront and the Port of Milwaukee, as well as additional developable land for the CBD. We look forward to partnering with stakeholders and the DOT to further conceptualize. The next question, what is the best primary use for former Northridge Mall site? We'll be talking a little bit about that today. Of the choices given, 3/4 suggest this site should be used for industrial or manufacturing space, which is desperately needed in this area. Market studies have suggested this would be the most marketable alternative and generate the most tax base and jobs. Multifamily, I should note, was not an option on this survey, but many suggested it in the comments, and I believe the City of Milwaukee is pushing for this use as well. Finally, should the City of Milwaukee provide tax increment financing for market rate residential developments? More than 60% said yes. More to come on that. That concludes our member survey results. Thank you, BizTimes, and all of today's sponsors and speakers. We look forward to this. Thanks.